All right, so let's dive right in today. We are talking about markets
Absolutely.
and something that happened this morning that has them a little spooked, I would say.
Yeah, a little bit of a jolt to the system, maybe.
Yeah, jolt this morning, we got the March Producer Price Index, and
Yeah.
it came in hotter than expected.
Yeah, 0.3% month over month. So that's signaling some more inflation. And, this is happening, of course, amidst
Right.
all the tariffs that we've been talking about, those huge tariffs on goods from China.
Yeah, exactly. Those 145% tariffs on goods from China.
Right.
So how do you navigate this? Like, how do you, as an investor,
Right.
figure out what to do with this information?
Yeah, I think it's always good in times of turmoil or uncertainty to go back to the classics.
Yeah.
And today we're going to be talking about The Intelligent Investor by Benjamin Graham.
Mm-hmm.
This is really like a foundational text in investing, a real roadmap for sound investing. And it's something that someone like Warren Buffett consistently points to as a great source of wisdom and really timeless principles. So what we want to do today is extract some of Graham's core principles from this book and see how they might be relevant for you listening as you think through your investments in today's kind of turbulent times.
Yeah, I love that idea of going back to the classics because, they've stood the test of time.
Yeah.
So let's talk about one of the big ideas in The Intelligent Investor, this idea of value investing.
Yeah.
So can we kind of unpack that a little bit?
Yeah. So at its core, value investing is about finding those companies whose stock price seems to be lower than what the company is actually worth and buying that stock. And the real key here is trying to ignore all those day-to-day market swings, that up and down, and really
noise.
Yeah, and just focusing on what's that real worth of the company beyond just the temporary price tag.
It's about seeing the forest through the trees, right?
Exactly. Yeah. And Graham has this fascinating concept in the book that I think can help us understand this. It's this idea of Mr. Market.
Okay.
So imagine the stock market as like a business partner you have, right?
Okay.
And his name is Mr. Market. And some days he's like incredibly optimistic, right? He's coming to you. He's offering to buy your shares at a premium.
Yeah.
He's like, I'm feeling great about things.
Right.
Other days, Mr. Market is pessimistic.
Ooh.
He's like really down in the dumps, and he's like practically begging you to take his shares at a huge discount. And that's the volatility we see. That's Mr. Market's mood swings, basically.
Oh, that's a great way to put it. Yeah.
And today, with this PPI news that we just got, that's signaling potentially stickier inflation that we thought Mr. Market might be feeling a little down. So we might see that reflected in, a drop in the S&P 500 is maybe 1-2%.
Yeah, that would make sense.
Which is a broad snapshot of the market.
So if Mr. Market is prone to these, emotional outbursts, how do we as investors kind of protect ourselves from that?
That's where Graham's idea of the margin of safety comes in.
Yeah.
It's all about creating a buffer in your investments.
So how do we do that?
So think about it like buying a house, right?
Yeah.
You want to buy a house for less than what you think it's actually worth.
Right.
So if the housing market dips a little bit, you're still in a good spot. And in our current situation in 2025 with the trade war, those tariffs potentially pushing prices up that margin of safety, not overpaying for an investment in the first place, becomes even more crucial.
Yeah, absolutely. So let's talk about that PPI number a little bit more, that 0.3% increase.
Yeah.
When 0.2% was expected. Like, what are we seeing happening in the market right now?
Yeah, so right now we're seeing NASDAQ futures, which are heavily weighted towards tech stocks, down by around 2%.
Wow.
So suggesting that, investors in that sector are a little bit concerned by this news.
Right.
Interestingly, gold, often seen as a safe haven asset during times of uncertainty, has jumped to $3,200 an ounce.
Wow.
And this inflation data also complicates things for the Federal Reserve, right? They're trying to figure out what to do with interest rates, and this might delay any rate cuts. And that also, of course, increases the worry about a possible recession, which some sources are now pegging at a 60% risk.
So going back to Graham, how would his long-term value-focused approach kind of guide investors in this kind of environment?
Yeah, I think Graham would say, look towards those more stable, more defensive sectors.
Okay.
Companies that provide essential services like utilities.
Yeah.
People still need electricity. People still need water.
Right.
Regardless of what the market is doing.
Right.
But of course, you also have to be aware of the bigger picture here. Continued tariff escalations could really put a strain on the economy.
Right.
We could be looking at, potentially billions of dollars in economic losses.
Yeah, absolutely. And, I think it's really fascinating how Grand's principles really resonate even today. And one of the best examples of that is Warren Buffett, right? He's constantly recommending The Intelligent Investor as a must-read for investors.
What's so insightful about Buffett is seeing how he's applied these principles at Berkshire Hathaway. And, despite all the market's ups and downs this year, Berkshire has seen solid growth.
Right.
And that really highlights, the potential resilience of that disciplined, value-oriented strategy.
Right.
And you see a lot of debate online these days about, should you buy the dip?
Oh, yeah.
Should you, run for the hills when the market goes down?
Yeah.
Buffett's focus on fundamentals really offers a different lens.
Yeah.
It's about looking beyond just trying to time the market.
Yeah.
Particularly during these times of inflation-driven volatility.
Yeah, and this latest PPI report, April 11th, 2025, really ties into the bigger economic story that we've been following, right?
Absolutely. I think it's a very direct indicator of those rising inflation trends that we've talked about before.
Yeah.
And it's clearly impacting the market dynamics that we've also been exploring.
Right.
So it's all interconnected.
Yeah.
And, I think your focus on these connections is great.
Yeah. Well, that's what we're here for.
Exactly.
So as our listeners are processing all this news, as they're thinking about their own portfolios, what would be your big takeaway for them?
Remember Graham's core message.
Okay.
Look beyond that short-term noise.
Yeah.
Focus on the underlying value of whatever you're investing in, especially in the face of challenges like trade wars and rising inflation.
Yeah, that makes a lot of sense. And, that really leads to this kind of crucial question for our listeners to consider.
What's that?
How can you most effectively build that margin of safety that we've been talking about into your own financial decisions?
That's a great question to ponder.
Absolutely. All right, that's all the time we have for today.
Great chatting.
Yeah, thanks so much for joining.
Of course.
And we'll see everybody next time.
Sounds good.